Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Lots going on today. Thanks for joining us. Coming up on the show, Bryden Teich, CIO and Portfolio Manager at Avenue Investment Management, will be joining us for the hour, taking a closer look at earnings from CIBC, RBC, TD, and more. In 20 minutes, Douglas Barrett, adjunct professor in the Arts, Media, and Entertainment MBA program at the Schulich School of Business, is here to help us understand the implications of the Warner Brothers potential deals. There's all kinds of them going on right now. Who knows where they'll end up? And the impact of that for the Canadian media industry. Then in 30 minutes, last night after the bell, Salesforce released its earnings. Patrick Walravens, Director of Technology Research, Equity Research Analyst at Citizens JMP, will be here for more of an in-depth look at those numbers. And of course, we want to hear from you this morning on First Call. You can reach us with your questions on North American equities. We'll have Bryden answer as many of them as he can at the end of the show. The number to call will be 1-855-326-6266. We'll open the phone lines in about 30 minutes. Our email, if you'd like to do that, is firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. TD Bank posted profit in its latest quarter that topped estimates, as well as revenue that jumped 18% compared to the year before. TD also saw record revenue in Canada, helped by a rise in loans and deposits and strength in its wealth management and markets segments. The quarter was also helped by a decline in the lender's provision for credit losses and higher banking revenue in its U.S. division. CIBC's first quarter earnings came in higher than expected, with the bank reporting profit nearly $1 billion above the same period last year, topping estimates. CIBC also posted better than expected results in its capital markets business and saw record revenue across all of its units, as well as a higher return on equity. This marks the second straight year CIBC has beat expectations as the broader banking sector continues to see strong growth across multiple segments. And we're not done yet. The Royal Bank of Canada posting first quarter profit that beat analyst estimates, driven by gains in its personal banking and wealth management segments. The bank also reported growth in its capital markets operations. RBC says it expects economic growth to remain positive despite heightened international trade uncertainties, and it forecasts modest growth in the first half of the year. And that is pretty much our top line story right there. RBC, CIBC, TD, all beating estimates. Let's bring in our guest for the hour, Bryden Teich, CIO and Portfolio Manager at Avenue Investment Management. Bryden, thanks as always for joining us.
It's great to be with you, Roger.
Would you like to choose? Which one would you like to talk about? Or just a general...
It's like you got 5 banks where baseball players, they all hit it over the fence.
Hall of Famers right now, aren't they?
Yeah, and I think what's interesting is the results that the banks have posted in contrast to, I think, the general sentiment that the Canadian economy has been weak and stagnant for the last year. And I think, again, the banks in Canada are showing their resilience, and the different business models or different business segments all seem to be humming. And I think, the concern from a couple of years ago with the banks was that we were going to have a slowdown in real estate after the COVID couple of year boom. That didn't really materialize. I think there's still concerns about what a down credit cycle would look like for the banks, but you're not seeing that anywhere in the results. And so I think for now, investors in the banks, I think, can sort of rest easy. And I think it's definitely a segment of the market that continues to propel higher, and these results in the last couple of days highlight that.
And it feels like with the housing market, it feels like they've negotiated that and found a balance and not lost customers, not lost mortgages on defaults, and that their losses were either in around expectations. A couple were even lower, if I'm not mistaken.
Yeah, I think the other thing too is you've had now a couple of years where the banks have been working through this mortgage renewal cycle from the last 5 years. I think the concern was, 2020 and 2021, you had interest rates on the floor. We then had interest rate hikes in the last couple of years, which took that renewal interest rate higher. They've managed through that very well, and I think there's still a shortage of supply in housing in Canada and all of those dynamics that the actual level of real estate has slowed down, but you're not seeing it in terms of loan losses or a down credit cycle. And the consumer is pinched, so maybe consumer demand in the economy is weaker, but everyone still needs a a place to live, whether it's a home or an apartment, renting or owning. And the loans in real estate and in the banking sector have been very resilient. And I think the results continue to highlight that. I think, you can sit and hypothesize concerns on the horizon, which is always part of, the hand-wringing that goes on managing investment portfolios. But the results, I think, speak for themselves, and the diversified nature of the different business lines. When you have results like this so uniform, it makes you sort of pause. Is the economy really as bad as people think it is with results like this?
Yeah, I was going to say, can we take that and expand and say, hey, it isn't? I mean, there have been concerns. We have heard talk of recession at times, but maybe we're not in as bad a spot as possible.
I think the dynamic that I think is interesting to sort of parse apart is, we've been in this essentially stagnant GDP per capita economy, which means that on average, per person, economic growth in Canada has basically been flat for the last several years. But nominal GDP, the actual size of the economy, has grown, and this is part of the dynamic of adding, a lot of citizens in the last few years, and sort of the per capita growth has slowed. Yeah. But nominal GDP has still been high, and I think the way to think about the banks is they are nominal GDP businesses, and so if the economy as a whole is growing, whether that's on a per person basis or we're just adding more people to the economy, I think all of that increases the demand in the economy, which helps nominal GDP, which helps the bank results. And capital markets have been strong. Obviously, the stock market's been strong. I think you've had a strong move last year and a lot of M&A activity too, which is great for the fee revenue for the different banks. Across the board, it's been great results. I think it's, I don't think there's not much more to question really with the results that they've put up in the last quarter here. And I think the question going forward is, can they continue to maintain that momentum? And
can people be satisfied too? We're seeing it with NVIDIA now. We're going to talk probably about that in a little bit. But stocks like that, the Mag 7, where you're seeing they're perfect pretty much, or they're running about as well as they can, but people aren't happy with that. They want more. Yeah. Can we see that with the banks? And which of the banks do you think posted? Is there one that kind of stood out a little more than the others?
So the two banks that we've owned for a long time are National Bank and Royal Bank. And I think I would sort of highlight National Bank's results. I think were very strong. They reported yesterday. And I think what they've shown is a very good implementation of their acquisitions of the Laurentian Bank retail side of the business and also Canadian Western Bank. So they're now, where they had legacy at National Bank was sort of a regional Quebec business. They were starting to spread throughout the country. But now with their Canadian Western Bank, you really now have an across the country platform that National Bank has been building. And they continue to be one of the highest return on equity banks out there. So a lot of high fee business. Their capital ratios across all of the banks are now very high. I think the question will be, what do the banks do with that excess capital? I think, the worst thing they could probably do is go out and do a bunch of acquisitions in the U.S., which was sort of always what would happen. But they're very well capitalized. They're in a good position, I think, right now. I think the question of the economy will linger. But the only risk I would sort of throw out there is when you have bank stocks start to go parabolic, at some point something will happen to disrupt that.
Something's got to give.
And it's not, anytime you have a parabolic move in a bank stock, I think you have to be a little bit cautious to be a net new buyer today. But for anyone who's a long-term investor, I think these businesses continue to highlight their resiliency.
With National, are there any more places for them to buy, or do they have to start growing organically now?
Yeah, I think
and becoming one of the consider themselves one of the big banks.
I think the two questions or the concerns are always, where is organic growth coming from in Canada? It's always been a challenging environment to grow organically in Canada for the banks, which is why they've always made acquisitions in the U.S. I think National Bank picking up Canadian Western Bank and then buying the part of the retail business from Laurentian Bank tactically. I mean, they get stronger in Quebec with that acquisition, and then they get a presence in Alberta. And I think where you've seen the growth biggest in the banks is all of their non-traditional personal and commercial businesses. So they all want to grow their fee business because it's a much higher ROE, return on equity business. You've seen the banks do that. I think the question right now is you're actually in a good spot because I don't think they're going to be going out and making a bunch of acquisitions, which was always what would happen at higher capital ratios. So they're really in a good spot right here with the results for this last quarter.
All right, we'll have to leave it at that. But lots more to talk about. And up next, we'll take a look at the markets before the bell. All right, let's see how things are shaping up on the markets. We'll start with the U.S. futures and a bit of an NVIDIA hangover, I guess you could say. The Dow's up 0.22, but the NASDAQ off slightly, pretty much a wash. And the S&P 500 also, it's up, but again, pretty much flat, both of them. Taking a look at the Asian markets and the Nikkei. Briefly, top 59,000 in intraday, closed at a record high, but was tempered by muted U.S. reaction with everything that's going on. And the Hang Seng down by 1.44%, CSI 300 off by 0.19. Heading over to Europe now. Busy earnings slate and NVIDIA reaction was slowing things down, but it's turned around now. And you can see FTSE's up by about 0.2, CAC up by 0.9, and the German DAX up by 0.4. And the TSX, another record day for it, finished above 34,000 for the first time, 34,127, up by 0.46%, driven by banks and miners. Some of the movers yesterday, Thomson Reuters surging again, up 10%. The Exchange Income Core up by 6.77. Going the other way, Element Fleet off by nearly 4%, and Loblaw off by 5.5%. And looking at the metals right now, they're all in the red. There's some profit taking with gold slipping below 5,200, off by 0.77. Silver down to about 87, off by nearly 5%. That's the volatility of that market right now. And copper still hovering around $6, even though it's off by 0.49%. Oil now. Yesterday, Western Canadian Select closing above 51. It was up 0.1%. And WTI south of the border, what's it doing right now? It's off, down to below 64. It had been up at 66 even. It's off by 2.6% at 63.71. Time to see what's on the radar. We're back now with Bryden Teich, CIO and Portfolio Manager at Avenue Investment Management. And Bryden, you've been watching the push that certain governments are making into critical resources. I mean, it's what everybody is talking about with AI and tech, the critical resources. Canada has a lot, and people are waking up to it, it seems.
Yeah, I think a lot of this refocus on the critical resource market started with the tariffs, and I think the recognition of just how much of China, or how much of the market for rare earths and critical minerals China controls, and I think when Europe, the U.S., and Canada is especially in a strong position, and as we were just talking about off camera, is really for the last 10 years we had sort of either both neglected and forgotten that, and I think in this environment where you're seeing this push from the U.S. has come out with their strategic stockpile of critical minerals. Obviously, Canada is in a position where we're not quite at that level of alarm because we have so much here. I think the question, and we've seen this directionally shift, but the question for Canada is taking these projects, moving them forward, and actually sort of highlighting our robustness in the commodity space, in the natural resource space again.
Do we remember how to do that?
I think from a policy perspective, I think there has to be a relearning of that. And I think that was, if you go through, previous cycles in the global economy, it's always been a resilient part of the Canadian economy. And I think, we were in this position where we were kind of shooting ourselves in the foot because we had deemed these kinds of parts of the economy to be less essential. I think the shift that we've seen in the last year and a half has now refocused that, where I think getting key projects in place and having government support for them, I think, is a critical part of what a successful Canadian economy looks like. And I think there's definitely been a change of sentiment, and you're seeing that reflected in the stock market, where different parts of the commodity space are reflecting that new reality, where governments are taking these projects much more seriously.
Well, we're seeing. I mean, one of the projects up in the Ring of Fire just got had to avoid an environmental or not an environmental assessment, but one of the assessments that may have taken a while. So that's one thing that we're seeing it sped up. Denison Mines just announcing that they're starting up that new uranium mine.
So Denison's one we've owned for a number of years. It's sort of the way, like thematically, this has been a thing that's sort of started to emerge in the post-COVID environment. But the way that we've tried to position for this is take very strategic small positions in what we think were going to be critical projects or companies going forward. And so we've been shareholders of Denison for now almost 4 years, but it's been a small position, and we just sort of let it give it time to breathe. Let's see how this project progresses. And yesterday they came out and said that the board has approved going ahead with this project in Saskatchewan.
And they're doing it in a unique way. First time in North America, I think. Right?
Yeah. So the challenge with a lot of these commodity large-scale projects is that they're just so capital intensive. And so Denison has this particular resource. I think they're expecting it's not going to be as intensive of a capital project just because of the way that they're going to mine it. I think that what's unique about the current moment, though, and it's for Denison or for some of the other energy names, is oftentimes you can have these commodity surges, but you do not have capital or support from capital markets. Mm-hmm. You have a moment right now where capital markets and the government are now supporting these projects, which is a different dynamic where a lot of these times, you could have a project that you want to put in place, but there's just no money to fund it. There's now lots of money looking for these kinds of projects and looking for, what are robust parts of the natural resource economy in Canada. And so having that capital and the government support now in place, I think is a key change from what we've seen in the last 10 years. And
do you think some of these miners, though, it's a new leader, right? Definitely in a different direction, Carney compared to Trudeau, but it's still the Liberals. Do you think some of them are waiting for some more confirmation that it's like, okay, this is actually real and we are going to go in that direction?
Yeah, no, I think that's absolutely the case. And I think any conversation with, an energy CEO or executive, I think that is exactly the sort of, the mindset and what's being communicated from that part of the economy. And it's, we've heard this before, and sure, okay, you want to support us. But a lot of this will be, the rubber will have to hit the road and there's going to be proof in the pudding. And I think we're choosing to be optimistic about some of these things just because we think that the consensus has changed in Canada where we don't have anything to do except to be optimistic about we have to do this as a country for these resource sectors is to be more supportive of them. Whether that or not that pans out, we don't know. But we're sort of taking that optimistic approach and sort of waiting to see how these things evolve.
And are the investors out there? Is the money out there?
I think absolutely. I think that's what it's so interesting about what's happening in the market, where you have all of these things moving either in tech or AI in the US, and the index is kind of slowly stalling out. But there's different parts of the economy and the market that have been very strong this year, and you're seeing investor appetite for commodities and resources very strong. And I think a lot of this sort of changing dynamic is what's driving that.
Okay, we'll have to leave it there, Bryden. Lots more to talk about. Coming up, what do major mergers and acquisitions in film and streaming mean for Canadian content? We'll talk about that after the break. The ongoing battle to acquire Warner Brothers continues to make headlines, focusing on whether Netflix or Paramount will end up with the deal. But what do these blockbuster deals mean for Canada's film and television industry? For more on this, we turn to Douglas Barrett, adjunct professor of arts, media, and entertainment at the Schulich School of Business. And Professor, thanks very much for joining us today. I just want to get your initial thoughts. Earnings came out today. Paramount topping out looks, Warner not so much. Does this give Paramount an edge at all, seeing those numbers today, or is it still a toss-up?
I think it's a toss-up. There are more plot lines in this story than in a, mid-afternoon soap opera. I don't think the earnings today have much impact on where it'll go. Ted Sarandos of Netflix is apparently at the White House all day for meetings, and the Ellison CEO of Skydance Paramount was at the State of the Union address, and Trump has said he wants to have Susan Rice, the former ambassador to the UN, fired from the Netflix board. So it's all kind of a usual Washington porridge, and we'll see what happens. Obviously, in the end, the shareholders will make up their minds, but Warner Brothers itself remains committed to the Netflix deal. That they've got a signed agreement with Netflix, So Paramount here is the interloper, and it keeps edging up its offer.
Professor Barrett, the question I come at this from is as a sort of casual observer, but definitely a non-media expert, is can you maybe parse apart why Warner Brothers is such a desirable asset? And obviously there's benefits for Paramount and there's benefits for Netflix. Can you highlight why I think either the IP is so valuable or just sort of the financial transaction just seems to be something that these two companies, Netflix and Paramount, can't do without?
Well, first of all, Hollywood has always run on the basis of these storied giant studios. And obviously, the studios at the front end are making new programming, but what they're sitting on is a pile of rights. So Warner Brothers might be either the largest rights holder in the world or close to it, and it owns franchises like Harry Potter and Game of Thrones. And Paramount, for its part, also a storied Hollywood studio, sitting on a pile of rights. It owns, Star Trek and so on and so on and so on. And because of now a decade or so of original programming from Netflix, it's sitting on a pile of rights. And so what we're really looking at is a fork in the road where these two of the three giant piles of rights will aggregate and be pretty dominant by a significant margin.
Let's take a look from the Canadian perspective. Vancouver, Toronto, Hollywood, they argue over who's Hollywood North. What kind of an impact would any of these mergers have, whichever way it goes, have on production up here and content up here?
Well, it's hard to say, and there's some other things in the mix. Remember, I said at the beginning that there's more plot lines than you can shake a stick at. But the first, I think, major issue for Canada will have to do with HBO and HBO Max, which is part of the Bell Media Crave service.
Our parent company.
Sorry?
Our parent company. I just want to get that in there.
That's right, your parent company. Crave has done very well recently. It's added a lot of subscribers. HBO is a very important part of its offering, highly promoted and so on. Bell Media has a long-term relationship with HBO. There's no immediate issue, but the question will be if Netflix gets the prize, will it fold HBO into the Netflix offering, and will therefore Crave and Bell Media, by extension, have a challenge when its agreement it comes up for renewal? Now, David Zaslav, who is the president of Warner Brothers, says that the plan is to keep HBO independent, and therefore still could carry on with an ongoing relationship with Bell Media. But I think that's the single most immediate threat. Second threat is that Netflix has not played nice in the sandbox with the theatrical release of a lot of the programs that it invests in. So the theatrical distribution industry in the United States is struggling. And if that practice continues, it would also impact on the theatrical distribution business in Canada. As to Canadian programs, that's kind of in the arena of the CRTC now and the Federal Court of Appeal and what's going on with the Online Streaming Act, because that act was an attempt to get the foreign streamers, principally Netflix, but a bunch of others as well, to make a contribution to Canadian programming in the Canadian system. It's unclear to me whether this deal, either way it goes, will act on the output of that question. If Canada is successful in maintaining its policy plans, then Netflix, in whatever form that it's in, and or the studios,
Okay.
and the Paramount Plus offering of the Paramount Skydance folks will have to play along. But looming on the horizon is obviously the Canada-U.S. Free trade agreement discussions, which are supposed to start up this summer. and the threats from the president about cultural protection issues. So Canada's cultural sovereignty is definitely on the line with those discussions. Whether this transaction would have a thumbs up or thumbs down impact, but obviously the Netflix folks and the Paramount Skydance folks have the president's ear and are working their way to make sure that foreign countries either are prevented from or, don't set up any cultural protection strategies.
All right, we have to wrap it up there, Professor, but thank you very much for joining us. We appreciate it.
My pleasure, and thank you for letting me speak this morning.
Douglas Barrett is Adjunct Professor of Arts, Media, and Entertainment, the MBA program at the Schulich School of Business. Still ahead, Salesforce reported mixed guidance last night. We'll talk about why that's worrying investors. And our phone lines will open soon for our first call segment. You can reach us at 1-855-326-6266 or send us an email, firstcall@bellmedia.ca. TD Bank posted profit in its latest quarter that topped estimates, as well as revenue that jumped 18% compared to the year before. TD also saw record revenue in Canada, helped by a rise in loans and deposits and strength in its wealth management and market segment. The quarter was also boosted by a decline in the lender's provision for credit losses and higher banking revenue in its U.S. division. CIBC's first quarter earnings came in higher than expected, with the bank reporting profit nearly $1 billion above the same period last year, topping estimates. CIBC also posted better than expected results in its capital markets business and saw record revenue across all of its units, as well as higher returns on equity. This marks the second straight year CIBC has beat expectations, as the broader banking sector continues to see strong growth across multiple segments. The Royal Bank of Canada posted first quarter profits that beat analyst estimates, driven by gains in its personal banking and wealth management segments. The bank also reported growth in its capital markets operations. RBC says it expects economic growth to remain positive despite heightened international trade uncertainties, and forecasts modest growth in the first half of the year. Taking a quick look at the market south of the border. In the green, just sitting there though. The Dow up by about a quarter. The Nasdaq, it's about a wash right now. And the S&P 500 up by a little more than 0.1%. Well, Salesforce reported a fourth quarter revenue beat, but issued a disappointing outlook for 2027 amid AI fears. Let's get more now from Patrick Walravens, Managing Director and Director of Technology Research at Citizens JMP. Patrick, thanks very much for joining us today.
It's my pleasure. Thanks for having me on.
Saw numbers like solid. Let's take a look back for a second. Was it a solid earnings report?
Yeah, overall it was pretty good. And I would say that Mr. Benioff and his team are battling through, yet another transition. He founded this company in 1999. So there was COVID, there was the great financial crisis, and now they have to adapt to the AI era.
And that's the big thing, right? Nobody's looking back anymore. They're all looking forward. The fear is software is done with AI. Is that realistic?
It's a little more nuanced than that. So if you look at what's going on at Salesforce, there's really three things I would point to. One piece of bad news and two pieces of good news in this earnings call. So the bad news is, if you look at the business organically, the growth rate decelerated a little bit from 9% to 8%. And that's really the AI headwinds hitting some parts of their business. It's hurting their marketing cloud, it's hurting their commerce cloud, and it's hurting a business intelligence product that they have called Tableau. And those are all areas where we're seeing a lot of advances in AI. Now, the good news, so point number two, your first piece of good news is that Salesforce has their own pure AI product. It's called Agent Force, and it is growing like hotcakes. So it did 800 million this quarter, and that is up. Are you ready for this? That is up 170% year over year. And then the second piece of good news is, the stock is down, I think, 27% year to date. It was down another 5% in the last night. Now it seems to be recovering a little bit this morning. We'll see. Might even end up in the green. But they announced a $50 billion buyback. I mean, that's like 25 to 30% of the entire market cap of this company.
Well, one question I have on that note specifically is it's interesting, and you're starting to see it with maybe a Salesforce pivot, but obviously the profitability of all of these software companies is still immense. And so to see the market reaction over the last couple of weeks in light of what is still an incredibly profitable business, whether you look at gross margins, return on capital, return on equity, it's substantial. And so do you think that management teams need to do a little bit of a pivot in terms of announcing buybacks, focus on capital allocation, and where a lot of the investor community had always looked on, what was year over year or quarter over quarter growth, where a lot of it has to move to the whole package of what are these companies doing in terms of buybacks? Because if your business is solid, a buyback at this level must be very accretive.
So, number one, the key part you just said was if your business is solid. So you need to make sure your business is solid. And that means that you need to adapt to the AI era. Just as a touch point here, if you look at the percentage of software companies that made it from the on-premise software era to the SaaS era, like 65% of them didn't make it. And so I think that's no one goes bankrupt, but their growth slows and eventually they get bought, right? And so I think that's a good sort of rule of thumb for what's going to happen this time around. So, point number one, you got to develop your own AI products that will offset the parts of your business that are getting hurt. And, Salesforce is doing a great job of that. Workday's also trying to do it, right? Basically, every software company has to do it. And then point number two, if you feel like you've made those changes and the market hasn't recognized it, then we would love to see the executives themselves buying the stock, and then a big buyback by the company, like what this $50 billion buyback by Salesforce is another great signal.
And I just want to going back to Agent Force for a second and 170% growth. Now, is that, obviously not sustainable at that level, but does it look like they can continue to grow that at a decent clip?
I think that is going to keep going for a while. So that's really only 5% of Salesforce's total revenue at this point. And this product didn't exist. They launched this product in November of 24. And then they launched, version 2 just a few months later, and then they had version 3 about a year later. So they really leaned in early and hard to coming up with their own AI solution. And it can be a lot more than 5% of the total business. So the Agent Force has a long way to run.
In terms of their AI business and the growth that they've had this last year, are there still substantial investments that they're making into this? And how do they, as a company, and Mr. Benioff, get the message out in terms of sort of the adoption? Because I think that, as you've highlighted, that pivot to AI is something you're seeing all of these companies start to do. And how do you think that they're going to continue to do that and are there levels of investment required for that?
So yes, they have to keep investing in it. How do they get the word out? They did something really unusual, and I wouldn't want to see this on every earnings call, but I think last night it was quite effective. Mark Benioff actually had 3 customers dial into the earnings call, right? One was a small customer, a company called Saster. One was medium, Shark Ninja. And one was large, Wyndham, one of the largest hotel chains in the world. And each of them talked about how they are using Agent Force in their business. And so that's how he's trying to get the word out. He is a gifted marketer, and He also needs to explain to the world how he fits in with OpenAI and Anthropic. And Salesforce is a small investor in Anthropic. And if Anthropic had a enterprise agents event recently, and interestingly, Salesforce was highlighted in that event as one of the customers who are embedding Anthropic in a product that Salesforce has called Slack. So those are all the kinds of things that they need to keep doing in order to explain, to help their customers understand that Salesforce has a great solution here too, and they should be giving it a try.
All right, we have to wrap it up there, Patrick, but thank you very much for joining us.
Yes, thanks for having me.
Patrick Walravens is Managing Director and Director of Technology Research at Citizens JMP. Still ahead, today's market drivers with Bloomberg's Divya Balji. And of course, our phone lines are open. Bryden Teich, CIO and Portfolio Manager at Avenue Investment Management, is taking your questions on North American equities. You can reach us at 1-855-326-6266 or email firstcall@bellmedia.ca. All right, time to take a look at some of the early market movers. We're joined now by Bloomberg's Divya Balji, Managing Editor for Breaking News in the Americas. Divya, thanks as always for joining us. And of course, it's the one everybody's talking about right now, NVIDIA.
Yeah, I mean, we talked about this yesterday too, and when we talked about it, I was talking about how, they tend to actually report really good numbers, but the market never seems to reward them in the way that we would expect them to. And that's literally what we're seeing, what we saw post-market yesterday and even this morning. They had a really great forecast revenue figure. Their fourth quarter revenue number was 73% higher than the previous year.
Wow.
These numbers, for any other normal company is something that you would just say, like you just said, wow. And, instead of seeing a massive jump in the shares, we're at about 1% of an increase for NVIDIA. Now, you could say it's a very large cap company, so a 1% increase is actually pretty good. But you do have this commentary out there from the market and from investors really questioning, how long can they hold on to this for? Is there truly the demand that they seem to think they have? Is that going to last for a while? Will they be able to keep that spending up for AI in order to continue this growth that they're on? Could other companies steal their market share? Earlier this week, we saw this mega deal between Meta and AMD as well. So are there competitors out there that are now coming back? Those are really the concerns that are out there. Now, analysts seem to think these concerns are overblown. They are actually very upbeat about the results, and they are saying that this is actually really strong numbers, and this is what the market should be focusing on. So, pretty interesting. It's like, you can't, even if you do well, you're not just getting that reaction that you want from your investors. And that's a tough spot to be in for a company like NVIDIA right now.
Yeah. And then there's Celsius, and people are loving what they're seeing about the earnings.
Yeah, I mean, it's an energy drink maker and a company that has actually done really well. Their sales numbers were also pretty great, and they beat expectations. A lot of this has to do with the Alani new acquisition that they made. They bought that company for $1.8 billion, and that's really helping with the surge in revenue that they've seen. Their shares are up today. A part of this also has to do with the distributor that they've moved to as part of this deal. Now the distributor is PepsiCo, and that's also helped with their sales. There's also this broader trend in the market of a lot of consumers switching to energy drinks as opposed to things like ready-to-drink coffee. That's also been helping with this company. One other thing an analyst brought up that I thought was interesting was there's a huge group of the demographic, and that's mostly women that are also getting on this bandwagon of energy drinks, and that's also possibly why the revenue has done so well in this quarter. So great day for Celsius after their earnings report.
All right, we'll leave it there. Bloomberg's Divya Balji, thank you as always. Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including Spotify. All right, time for some notable analyst calls and recommendations. We'll start with Spotify. Shares are up 1.7% in pre-market trading after Areta upgraded the audio streaming company to buy from neutral after de-emphasizing multiple failed efforts at diversification. Spotify is now consistently generating double-digit FCF margins, and it still has early-stage initiatives which individually should support modest margin expansions, the firm writes. PT, $586. TD Cowen raising the recommendation on NASDAQ to buy from hold, citing increased confidence in the company after its investor day and an attractive valuation for shares. Our actions follow greater confidence in the durability of the platform, particularly in fintech, following 26 investor day. Analyst William Raymond Katz wrote in a note, PT set to $106, applying a 26% increase from Wednesday's closing price. When we come back, Bryden Teich, CIO and Portfolio Manager at Avenue Investment Management, takes your questions on First Call. All right, time for First Call, first email, and that one is from Mike, and he says, good morning, Roger and Bryden. Is GE Vernova overpriced at this point, or does it still have significant room to move given its increased backlog and future outlook? Thank you.
Well, thanks very much for the email and for the question, Mike. So GE Vernova was GE's legacy, part of their energy business that was spun off almost a year and a half, 2 years ago. Obviously, that's benefited substantially from a lot of this investment in hard asset in terms of the energy grid and infrastructure. You probably couldn't have spun it off at a better time. And so thematically, this has really been a name that's worked since then. I think the question is, and this is for sort of this broader theme of infrastructure spending and electrification, is that there's now a lot of money in these names chasing them. So GE's valuation now is about 50 times earnings. And so you have to balance the fact that this could be a very long duration investment cycle, which GE could benefit from. And then at the same time, the multiple is very high, so investors are already pricing in a lot of that expected growth in the future. So that's exactly sort of the what Mike highlights in the question. And the real answer is I don't know. You'll have to see how this plays out. I mean, thematically, I think that there is a long duration to this, but you don't necessarily want to be buying a stock that's gone up this quickly, this fast, and at this multiple. But I think if you have a market give a little bit of a break or the shares give some kind of a pullback, I think it's a name that's interesting. It's not one that we own, but we're always looking in and around that investment infrastructure space, and GE would be a name on our list that we could look at in the future. And
any concerns with we've had Trump, the president down in the States, has been saying that the data centers and that might be paying for their own energy. Does that play in to any of this?
No, I think
energy is energy. They got to get it from somewhere.
I think the question will be, at some point, the stock market will not reward these companies for making all this investment. And I think I saw a number that Amazon and the hyperscalers as a group is going to spend somewhere between 600 and 700 billion on CapEx this year or next year. That's a crazy huge number. And so if that number is true, all of these stocks will continue to benefit. If that number is not true, there's a world of hurt out here for businesses like this. And so we'll have to see what happens.
All right. We'll leave it there. On another email, this one from Ron. I would like your views on Manulife, which lost about 10% of its value in February alone and is below its 50-day moving average, while it is looking to buy back 2.5% of its shares, and analyst ratings are generally positive.
So thanks for the question, Ron. So Manulife had done very well over the last couple of years. I think it's pulled back in the last month or so, but this is a name that most Canadians would be familiar with. And I think it's still an attractive business. The insurance business and wealth management business of Manulife has been very strong and resilient the last couple of years. One of the things that they've really pushed in the last decade is to grow internationally. So they have a lot of insurance and wealth management businesses in Asia and other parts of the emerging world, and even in India. India is a big market for them. Right? Yeah. So, I mean, those are all secular, long-term, big growth areas for the business. I think the question or the concern with a Manulife is always, do you have some kind of legacy liability hiding in your balance sheet on page 184 that no one read, because that's the nature of their business. Is you're selling long tail insurance. You just don't know what the profitability will be like on a lot of these projects or products. So I think that the theme that should continue to work is this Asia wealth management insurance, and that's, I think, the main growth vehicle for them. And you're not paying an expensive multiple, 15 times earnings. It's about a 4% dividend yield. So it's not a name that we own currently. It's on our list that we're always going through, but we prefer the Canadian banks or some of our. We have a couple other specific property and casualty insurance businesses that we prefer. All right. But Manulife, I think, has done well, and I think the shares have largely reflected that.
Okay, we got time for one more email. This is. We would like to get your guest's view on, who's it from? It's from Mike. Okay, there's the name. We'd like to get your guest's view on Brookfield, BN. Almost out of time.
Yeah, so thanks, Mike, for the question. So Brookfield, it's been a great business for a long time. I think the question in the private credit, private asset space is there a mismatch between valuations and liquidity? And I think Brookfield is sort of in that category, given what their business nature is. I think it's not a business we own, and we think that it's too much of a black box for us. Mm-hmm. And we prefer a sort of a pure play Canadian bank or a property and casualty insurance or a very specific type of asset management business, rather than sort of the black box that Brookfield is. It's not that Brookfield's not an amazing company, but for us, it's too much of a black box.
Okay, we're going to have to leave it there, though. Bryden, thanks as always for joining us. Thanks to Bryden Teich, CIO and Portfolio Manager at Avenue Investment Management, for being here today. Andrew Bell's up next with the Open. Trading gets underway in about 30 minutes. Easy for me to see. Have a great day.